You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at @TIWTweets.
Hello, welcome to The Investor Way. It's the 21st of April 2025 and I'm joined today by my co-host John McEwen. In this week's episode we'll be discussing Tesco, JD Sports, Sainsburys, ASML, Heineken, and our US company of the week is Match Group. John, do you want to start with our first supermarket of the week?
Absolutely. So it's Tesco's, and it's Britain's biggest supermarket with a 28.3% market share. It's one that's done quite well since I sold it, and I think I was maybe marginally up after dividends, but it's been actually quite difficult seeing how well it's done since. Anyway, it had its full-year results out, with the group reporting full-year retail sales of £63.6 billion, up 4%, ignoring exchange rate impacts. This was driven by growth across all regions at the Tesco stores, which helped to offset a 1.8% decline in Booker, which is its wholesale division. Underlying operating profit rose 10.9% to £3.1 billion, helped by volume growth and cost efficiencies. Free cash flow fell by 15.2% to £1.8 billion, largely due to less favourable timing of stock and customer payments. Net debt improved by around 200 million to 9.5 billion at year-end. For the new financial year, Tesco's expects underlying operating profit to land between 2.7 and 3 billion pounds, and that's below previous market expectations. Free cash flow is expected to remain within medium-term guidance of between 1.4 and 1.8 billion. The final dividend of 9.45 pence per share takes the full year total to 13.7 pence, 13.2%. A new 1.45 billion share buyback programme has been announced to be completed by April 2026, and the shares were down around 4% in early trading. I thought these results were actually fairly alright, and I think the fall in the market share is really that lower guidance, because otherwise they seem pretty decent. We have come to get used to some very strong numbers from Tesco's in the past few years, and perhaps these are slightly on the weaker side. Of course, there is a lot of turbulence in the market, and there is the macro situation with what's going on in the US at the moment, and I guess also the potential price war that's maybe emerging again in the grocers, which, even if it doesn't materialise, I think is having a knock-on impact on sentiment. In terms of valuation, Tesco's has a market cap of 23.7 billion and trades at 11.5 times forward earnings, with a dividend yield of 4.3%. Overall, though, I think for me and Tesco's, and part of the reason that I sold it is not that it's not doing well, and it's certainly the dominant force in terms of the grocery market in the UK, but I think it's probably that lack of growth opportunities for the group. They did try in the 2000s to expand and go overseas, crack the US and Central Europe, Thailand, and whilst Thailand initially and some of the Central European markets it still has, it largely failed in the US and suffered some massive write-downs. And I think that does show its growth, whilst it's got the main market share in the UK, is really limited to the UK. And that was, for me, the reason that I ultimately sold after having a bumpy few years. And it's probably the reason that I wouldn't buy shares again. I guess on the other side of that, it's, well, what's the purpose of buying it? And it has shifted now significantly more to returning cash to shareholders, whether that's through the share buyback that's been announced or that fairly decent 4.3% dividend yield. So not one for me, but I think you could do a lot worse. And certainly if you were in the market for a grocer, then I think Tesco's is probably the best pick. And it's certainly not an unreasonable valuation at 11.5 times forward earnings with decent dividend and share buyback. Sam, what are your thoughts on these results in Tesco's?
Fairly similar. I think the results are pretty good. as did you. I think in terms of the cash that's been returned, I think it's actually quite attractive. So you've got, as well as a 4.3% dividend, that buyback for 1.45 billion, so when's that to be done by? April 2026. So that's in the next 12 months. And that's on a 24 billion market cap. So it's a few percent. It's a decent amount, which when you add it onto the dividend, is probably like a 7 to 8% return to shareholders in the next 12 months. I think as well, I'm not really sure what's caused it, but I don't know if it's, they had a statement come out before these results or something, but the share price just seemed to fall off a cliff back in March. Because I sort of recall last time we covered Tesco and Sainsburys, Tesco was more expensive, and I think the conclusion was kind of based on that, Sainsbury's might actually be more attractive. It looks like they had a day where the share price must have fallen from like £3.75 down to like £3.20. I'm not entirely sure why, but yeah, now it's at like £3.55. It's probably, it's a bit more reasonably priced again. Without giving any spoilers, it's more in line with that Sainsbury's valuation. But yeah, I think I wouldn't buy it expecting growth, but I think it probably is the best supermarket that you can buy. And I think the returns to shareholders presently are quite attractive.
Would it be of interest to you at all?
Probably not, just because of opportunity cost. I think that would be the main thing for me. Without that growth there, I think I could probably get, I wouldn't say a similar kind of return to shareholders, because I think it's like 7% in the next 12 months. That's unusually high. But I think you could go out and get 3 or 4% dividend anyway from a company that's probably, you would hope, would have more than a few percent a year capital growth ahead of it as well.
Sure. Okay. On to another retailer then, JD Sports.
Yes. So JD Sports is, I'm sure it's a company that needs no introduction, but they sell trainers for anyone who's not aware. And they have come out with a fourth quarter trading statement, and they've reported organic sales growth for the fourth quarter of 5.6%, with all regions in positive territory and sales up double digits in Europe and Asia Pacific. Full year tax before profit guidance has been reiterated and is expected to be in the 915 to 935 million range. This year revenue is expected to grow, with recent acquisitions and new floor space expected to contribute around 10 and 4% respectively. Profit before tax is expected to land in line with current market expectations of 920 million. Both of these expectations exclude the potential impact changes to tariffs on global trade. As part of its medium-term update, JD have announced that it's moving to a period of lower capital investment, which is expected to fall from around 5 to 3 to 3.5%. With no material merger and acquisition targets in the pipeline, they expect the funding position to improve. And they've also announced a £100 million share buyback, and the shares rose 8.8% following the statement. This statement has come after a number of sales and profit downgrades. They have also said that they expect the changes to national insurance and minimum wages to add around £30 million of additional costs. However, if profit before taxes, say we take the average of 925 million, it's annoying, but I don't think it has a huge impact like it does for some other businesses we've covered. We covered last time, we've covered it. They've made recent acquisitions in the US and France. And for the Hibbett acquisition, that now means that the US is JD Sports' largest region by sales. And for a lot of these stores, a lot of the goods are manufactured in countries like Vietnam and China. So as you can imagine, it's not had the best of times with the tariffs recently. It should be mentioned as well, the guidance for the profits to remain flat, that excludes the impact of the tariffs, I think, because they can't really assess the impact because no one really knows what the tariffs will be at this point. That has affected the PE. So it was a stock that used to be quite expensive, and it's now trading at a forward PE of 5.1, and that compares to a 10-year average of 16. And it now has a prospective dividend yield of 1.6% compared to a 10-year average of 0.5%. If you look at the share price, it is a few years ago since it did peak, but it peaked at over £2 a share, I think maybe like £2.30 a share, something like that. It's now at 75 pence a share, and it actually hit a low of 61 pence a share this year. So it is down significantly. And even, I mean, that was the absolute peak, but even then it was over £1.50 a share. Really, prior to the stuff with the tariffs, it's really, it's been cut in half as a result of that. Whenever we've covered it, I think we both had some concerns about it and also the strategy it's adopted. And I think what's going on with the tariffs is no fault of JD's. Now, I think any impact would be temporary anyway if it is affected, which if the tariffs go ahead, it almost certainly will be. However, I think it's a quality enough business to probably be able to ride it out. I think at a forward P of 5, I actually think it's quite attractive. So although I think I've got long-term concerns about the industry, especially with like Nike and Adidas trying to push towards direct consumer, I think they're far enough away that at 5 times earnings, I'd expect to get my money back.
Yeah.
Now, the reason I wouldn't buy it, I think if I'd spotted this a few weeks ago, I might have taken a serious look at it, in all honesty, and just because it is that cheap. But having just started a position in Nike, I feel like I've got enough exposure to that industry. But I think it's cheap enough that it's still a good brand, and I think there's probably a decent opportunity there. What do you think, John?
Yeah, I mean, I would agree with you on the direct consumer, and I know that's a point we've raised before with JD. I suppose it depends how much volatility and risk you're prepared to take in seeking the value on it. I don't think I would be up for that, quite honestly, but I take your point. If you are seeing it as a short-term turbulent time in terms of whatever the tariffs may be, and clearly the market is expecting that in terms of the way it's reflected in the current valuation, then you might see this as a great opportunity and the cheapest that you could own JD potentially in a long time, although there's nothing to say that that won't get worse in the short term. I don't think there's probably enough quality for me to want to buy the shares. So I think there are, as we've sort of highlighted on the previous episode, plenty of other companies that would be more appealing for us than JD, albeit not as cheap as JD currently is.
Should we move back to the supermarkets in that case?
Okay, on to Sainsburys, which is Britain's second largest listed supermarket, also have their full year results out, with full year retail sales of £31.6 billion, up 3.1%. Growth was driven by a 4.6% uplift in grocery sales as volumes grew ahead of the broader market. This more than offset a 2.7% decline in Argos. Retail underlying operating profit rose 7.2% to £1 billion, fueled by top-line growth and ongoing cost-cutting programme. Free cash flow fell by around £100 million to £500 million due to higher levels of investment and unfavourable timing of supplier and customer payments. Net debt rose by around £200 million to £5.8 billion at the year end. Full-year guidance points to retail underlying operating profits of around £1 billion, and it was previously guided at 1.1, and retail free cash flow of more than £500 million. A final dividend of 9.7 pence per share has been announced, taking the full-year total to 13.6 pence, up 3.8%, and a new share buyback programme and special dividend have been announced, expecting to total at least £450 million, and the shares were up around 3.5% in early trading. In terms of valuation, Sainsbury's has a market cap of £5.94 billion and trades at 10.3 times forward earnings with a prospective dividend yield of 3.8%. Again, I thought these results were pretty good. Very impressive to see volumes growing ahead of the broader market. Slightly disappointing with Argos, but again, a story that we've come to get used to with Sainsbury's. Similarly to Tesco's, they're returning a lot of money to shareholders with the share buyback, and the dividend yield is substantially higher anyway. And certainly don't think it's a top evaluation at 10.3 times forward earnings, and obviously got that decent dividend yield and share buyback. Again, I think with Sainsbury's, it was one that has been pretty unloved, and it certainly wasn't in a good state a few years ago. Tesco was a much slicker operator. I think we have seen Sainsbury's turned around. It's competing well on price, and it's also got some of the premium products with the Taste of Difference range, which is doing well. I think this is, again, a decent company. It's not one that you'd be expecting or is priced for huge growth, but certainly an income investor, I think you could do a lot worse. Sam, your thoughts on Sainsbury's and this set of results?
I think the results are decent, apart from Argos, but when you think of Argos, I kind of assume that's a business that will gradually decline anyway. I mean, all I remember them for is the catalogues. I think it's less of an issue anyway, given that they're integrated based into Sainsbury's stores in any case. I don't like the debt. I think that's quite high. And I particularly don't like a £450 million share buyback program when the debt is almost 6 times operating profits. I think the company performance is pretty good. I think the company is good, but I do question whether it might be better to pay off some of the debt instead, unless that's locked in at really low interest rates, which for all I know it could be. But the days of those low interest rates are getting further and further away, and you'd expect as more and more debt matures for companies, it's going to be at more reasonable interest rates now.
Yeah, and I think they've had some further cash coming through after selling the Sainsbury's bank. It was about 250 million to NatWest. But yeah, I think I would agree with you in terms of the use of that cash to pay the debt down further rather than immediately going out to shareholders. But yeah, fair point.
Right. Shall we move on then to our first Dutch company of the week?
Absolutely. So ASML.
Yes. So it's not actually far off being. I'm just seeing if it's the biggest, because now Novo's taken a plunge. It might be the biggest company in Europe. It's a German software company, SAP SE. SAP SE, the German software company, has a market cap of 284 billion euros. ASML is lagging behind at just 229 billion. So has overtaken Novo Nordisk, but unfortunately it's still not got that number one spot. But anyway, ASML, so for anyone, I think we may have covered them before, but I'm not 100% sure. So for anyone who's not familiar with ASML, they are a Dutch company and they specialize in the development and manufacturing of photolithography machines used to produce semiconductor chips. And these machines are essential for transferring intricate patterns onto silicon wafers, a critical step in the fabrication of microchips that power everything from smartphones to computers to AI servers and electronics. So they don't manufacture the chips themselves, they just provide the hardware, software and services that enable chip makers such as Intel and Samsung to mass produce these circuits. And they hold a near monopoly in the production of EUV lithography machines with no significant direct competitors at all. They're basically indispensable in the semiconductor supply chain. And my worry is, well, what's to stop someone else coming in and doing this? So bear in mind, I don't know a lot about this. It's not an industry I'm particularly hot on. So I've asked AI what's to stop someone else entering ASML's market. And the answer it's given is that, firstly, EUV lithography is one of the most technically challenging feats in modern engineering. Generating and harnessing EUV light requires firing high-powered lasers at tin droplets to create plasma at temperatures of over 200,000 degrees. So essentially, it's very, very difficult. And the entire system is so complex that it's often described as the most complicated machine ever made. ASML spent more than 2 decades and billions of euros developing and commercializing EUV technology, which means that anyone who wanted to enter the market has huge upfront costs, and even then they might not know if they'll be able to dislodge ASML. And many of the critical components are supplied by companies that work exclusively with ASML. And as an example, Trumpf, which co-developed the unique laser system, only sells the lasers to ASML. And many other suppliers are similarly locked in, making it impossible for competitors to source the necessary parts. In addition, they have over 2,000 EUV-related patents. So basically, as long as people need semiconductors and chips, they need ASML. Now, ASML have come out with their first quarter results, and first quarter net sales was 7.7 billion euros, which was in the middle of the guided range. Net bookings were 3.9 billion, which was below 4.8 billion expected. However, they were up 9% year over year. Operating profit increased from 1.4 to 2.7 billion. There was a free cash outflow of 400 million with net cash at 5.4 billion. The outlook for 2025 is unchanged, with net sales expected to be between 30 to 35 billion euros and Q2 guidance expected to be 7 to 7.7 billion. And that's below the 7.8 billion that was expected. Final dividend of €1.84 has been proposed, taking the total to 6.40, which is up 4.9%. In the first quarter, they purchased 2.7 billion worth of shares under the current buyback program. As I mentioned, that's on a market cap of 222 billion, so buying back just over 1% of the share count a quarter. In terms of the tariffs, they have some exposure to US manufacturing and imports and exports, but they're relatively insulated from direct tariffs. If anything, you would kind of think if someone were to slap some tariffs on these, say America, people would just have to pay them. It sounds that entrenched and that essential that I think ASML would potentially be strong enough to take the view it's not their problem. In terms of the valuation of business trades at a forward PE of 24, and that compares to a 10-year average of 30, it has a prospective yield of 1.2%, and that compares to a 10-year average of 1%. And in terms of the share price, it's down about 40% this year. So it's been over €1,000 a share. It's currently sitting at 567. So it's come down quite a lot, but it is still not cheap. I'd probably put this in a similar category to Novo Nordisk, actually, where it's like, it goes in the too hard pile. From the limited amount I'm able to understand, it looks like they have a fantastic product, and it looks like this is particularly entrenched, and everything I've kind of read and seen suggests that they do actually have a moat. I think the issue is whether the industry changes rather than someone coming in and producing their products for less than them. I don't think that's possible. I think it would have to be some kind of shift away from their products, which seems pretty unlikely in the near to medium term. My issue is I just find it probably a bit too difficult to understand. I wouldn't be fully comfortable with it. Now, the difference with Novo Nordisk is you can essentially, I know you can't borrow conviction, but it did give me a lot of ease. The fact that, Terry Smith and his team are so bullish on it, having done that research and having had people who do understand it a lot better looking at it. But with ASML, I don't really have that conviction is the issue. And as well, I actually felt like Novo Nordisk, because that's now trading at a PE of 16. And I also felt like the PE had come down enough to actually compensate for my lack of understanding. Whereas at a forward PE of 24, I think a lot still has to go right. And it may well do, because it seems like a very high quality business. But if it's only growing revenue 9% or whatever it was, and it's a business that I don't really understand and I'm not fully comfortable with, I think it's a business I would actually be potentially interested in at the right price, but that right price for me would be a lot lower because it would have to be cheap enough to compensate for my discomfort, I guess, which I think is a price that we're probably unlikely to see, given that it does look like an excellent company. What do you think, John?
Yeah, no, I think we've covered it once before, but it was much more so superficial. And looking at it and probably appreciating the quality and how deep that moat is doesn't certainly make it more appealing. If you take the view that we're going to continue with the demand for tech and the demand for chips, the Internet of Things, then ASML, it's got a lot of growth ahead of it, even though, when you look at the share price and the charts, which I know do, but you think it's had sort of a huge run up to the current point, or at least it has until sort of 6 months ago. So yeah, I certainly think it's very attractive. There is that too hard pile argument, and I think before buying shares, I'd need to know the market and potentially any competitors. But it does seem like it has a fair monopoly on the sector it operates in, which I guess is why it is commanding that higher valuation. But no, certainly looks like a fantastic company and one that would probably be going on my list to research further and maybe loosely on the watch list.
Yeah, and the results, if you go back and look at over 5 years, they have been exceptional. So, revenue's grown from, the last 4 years actually, so I've got 5 years of results, but revenue's grown from 14 billion to 28, so it's doubled. However, the gross profit has more than doubled. That's gone from 6.37 to 14.5. Operating margin has actually improved slightly, 30.36 to 31.92%, and the earnings per share, diluted earnings per share is up from 8.83 to 19.22. Dividends up from 2.34 to 5.44. And it's nice to see a European business like this, actually. I know it's not UK, but even still, it's nice to see a business this important that's not American.
Yeah, well, I mean, the UK had ARM, which is now listed in the States. Not quite as big, but I think it's got a market cap of maybe about over 100 billion for sure.
Yeah, so, should we move on to our second Dutch company of the week?
Absolutely. So it's Heineken, which is the brewer. has brands like Heineken, but also Moretti, Old Mount Cider, and they had their first quarter results out, with Heineken reporting better than expected underlying net revenue of €7.8 billion in the first quarter, which is up 0.9% on an organic basis. Growth was driven entirely by higher average prices, which offset a 2.4% decline in volumes. Premium beer volumes grew at a faster pace of 1.8%, led by Vietnam and India. And Heineken was the standout brand with total volumes up 4.6%, including double-digit growth in 25 markets. Heineken called out uncertainties related to the impact of recent tariffs, and changes in exchange rates are set to be a headwind to profit this year, but are expected to be more than offset by around €400 million of cost savings. The full-year outlook has been reiterated, with underlying operating profit to grow by between 4 and 8%, against the market consensus of 6%. Around €87 million of shares were purchased in the period, with a remaining €750 million share buyback programme set to be completed by January 2026. And the shares were up around 2.5% in early trading. In terms of valuation, Heineken has a market cap of €45 billion and trades at 14.5 times forward earnings, with a prospective dividend yield of 2.7%. I thought these results were a bit disappointing, particularly when you're seeing volume declines of 2.4%. Yes, there are some encouraging signs in some of the markets where you've got the higher double-digit growth, but I think in an industry like this, it is all about volumes. And I know as people are drinking less, you've got the trend in the brewers and the distillers towards having more premium end products. I think that works better in spirit, but as you're seeing with Diageo, that's still not an easy feat. And I think it works less well when you've got the premium beers. At 14.5 times forward earnings, I think it is actually quite expensive for what it is. And whilst Diageo has been having a difficult time, I would certainly choose that before Heineken. But that being said, it's not a business that I like, and I wouldn't be buying shares in it. Sam, what are your thoughts on Heineken and these results?
Very similar. I think the volume decline is concerning. Yes, they've been able to mainly offset it with higher prices, but I think when you look at the brands in the portfolio, there are some good brands in there, but there is a price at which people will just switch. There's not a huge amount of loyalty. I don't drink a huge amount anyway. I'm probably part of the problem, but yeah, I will sometimes get an Old Mout cider. If they increase the price too much, I will just switch to Recorder or Copperberg or something else. I don't have a huge amount of brand loyalty, and a lot of the time it's just based on what a bar is stocking anyway. But yeah, I think it's concerning. I think, as you've alluded to, I think with sort of Gen Z drinking less and stuff, my concern is that this could be the start of a long-term trend. Now, a company we also cover a lot is Diageo, and although, as you mentioned, Diageo have been struggling recently, I think with Diageo, the fact that their brands are more premium, I think insulates them more than a Heineken, where for Heineken's business model to work with those brands, they're relying on the volumes. And if the volumes start dropping, it's a lot more concerning than for Diageo. Now, for Diageo, it's not great, but I think Diageo has much higher ability to increase prices. So yeah, for me, I would be really concerned by this. It's probably not a business I would be interested in anyway. Yeah, I agree. At a forward P of just under 15, especially when I think Diageo's at around like 17 at the minute, and I think it's a higher quality business. I just wouldn't touch this. I think I just have too many long-term concerns about it.
Fair enough. What about Match Group?
So, Match Group. So, it's a company we have covered before. I think if you're not familiar with Match Group, you're probably familiar with its product. So, it has Match.com, it has Tinder, it has Hinge, and it has a number of others as well, actually, that you probably have heard of in the dating space. So, they have come out with their Q4 and full year results, and revenue was up 3% to $3.5 billion, and that was up 6% on a currency neutral basis. And that was driven by an 8% year-over-year increase in revenue per payer, which is revenue per subscriber basically, to $19.12. partly offset by a 5% year-over-year decline in the number of paying subscribers to 14.9 million. Operating income was $823, and that was down 10% year-over-year, and that now brings the operating income margin down to 24%. Operating cash flow and free cash flow were 933 and 882 million respectively, and 85% of the free cash flow was used for share repurchases. The company repurchased 753 million of stock during the year, representing 22.2 million shares. As of February 2025, 1.75 billion remained available for repurchases under the current repurchase program. The number of diluted shares outstanding was 260 million at 31 Jan, and that was a decrease of 7% from the year before. So those are the figures for the year as a whole. If we just go into the final quarter, revenue was down 1%, and the decline in payers was down 4%. Operating income margin was a bit higher at 26%, but operating income itself was down 14% from the year before. And the company repurchased in the quarter $117 million of stock at an average price of $37.38 per share. Well, if we go into the highlights for Tinder, they had direct revenue of 1.9 billion, which was up 1%, and that was driven by an 8% increase in revenue per subscriber, but that was largely offset by a 7% drop in payers to 9.7 million. And the Tinder full year subscribers basically generated an operating income margin of 45%. For the quarter, the revenue was down 3% and the number of payers was down 5%. If we go down a bit further, the other main brand they have is Hinge. That had revenue of 550 million, which was up 39% year over year. That was driven by a 23% year over year increase in payers to 1.5 million and a 13% year over year increase in revenue per payer to $29.94. The operating income was 121 million and that increased 64% year over year with an operating margin of 22%. I would expect that to keep growing. I think the operating margin will go up. And what I would hope is happening is that although Tinder is maybe being eaten away at by competitors, one of those competitors is Hinge. So to a degree, it's cannibalizing itself, which is probably better than someone else cannibalizing it. For the quarter, Hinge revenue was up 27%, and that was driven by a 19% increase in payers and a 7% increase in price. And the operating margin for the quarter was 21%. And for the outlook, they expect revenue for the first quarter of 2025 to be down 3 to 5% and adjusted operating income to be down 5 to 7%. For the full year, they expect revenue to be between down 3% to up 1% and adjusted operating income to be roughly flat. In 2020, the operating income was 31%, but that's now at 24%. So the margins are actually getting worse. They do have a significant amount of debt. They've got about 4 billion of debt. My understanding is that's at relatively cheap rates. And in all honesty, given the amount of cash flow it's currently generating, that's pretty manageable anyway. The Tinder subscribers are concerning. So that's 9.6 million, but that's down from 10.4 at the end of the 23 calendar year. It was 10.9 at the end of the 22 calendar year. However, like I say, Hinge is offsetting that to a degree, but off a smaller base. One thing that I think is interesting is they've been through a few CEOs in the last few years, but as of February 4th, they are now on another one. And the guy who's come in is called Spencer Rascoff, and he co-founded Zillow Group and was running that for a decade, well over a decade. Also co-founded Hotwire, which was a breakthrough online travel marketplace, and Tesco, a prop tech company reshaping second home ownership. So he seems pretty decent. So he's come in and he's now basically been going on about improving the user experience, and that's what they're going to be focusing on. And if we go into, I'm going to jump around a bit now, but the next thing I wanted to look at, because these results weren't great, but as far as I'm aware, Tinder has the best brands in the dating industry. I was wondering what the market's doing. So for the dating market overall, global users are currently 364 million. Well, they were in 2024, and that was expected to grow by the end of 2025 to 500 million. Now, a lot of that's growth in emerging markets. However, the point is that it is still very much a growth market. The dating app market had $6.18 billion of revenue in 2024 and $3.5 billion came from Match Group. Over 350 million used dating apps worldwide, with about 25 million paying for premium features. To me, overall, that actually seems quite low. Tinder was the most downloaded app in 2024, followed by Bumble, and Tinder is the most popular dating app in the United States. In terms of dating app revenue from 2015 to 2024, it has grown from probably about 1.6 billion to over 6 billion. Global dating app users, that is up from 200 million in 2015 to over 350 million in 2024. Downloads for the apps have actually decreased over the past 5 years from a peak of 287 million in 2019. So in terms of the number of global users, Tinder is still by far and away the biggest. That has 90 million users, give or take. The second biggest is now Bumble, which is getting on, it's probably just over 35 million. So Tinder's still significantly the biggest. The next one's Badoo, that's more popular in Asia, but that is owned by Bumble. And the next one is Hinge, which has about 30%, but Hinge is doing very well. In terms of the US market share, it's actually a lot tighter than I would have expected. Tinder has a 25% market share. Bumble has 24% in the US. I wouldn't have expected it to be that high. However, Hinge has 18% and Badoo only has 4%. So if you were to combine the two companies, Match is still comfortably beating Bumble. I know I'm going on a lot, but part of the reason is because I am considering opening positions in actually both of these. So basically out of the top one, Bumble and Match kind of own them all between them, all the recognisable ones. Interestingly, Bumble, if you look at their results for the calendar year, so their app paying users is still increasing, so it's taking market share off of Tinder. The growth has slowed, so it grew from 2.7 to 2.8 million paying users last year. However, it's done that by decreasing the price, the revenue, or getting them in cheaper areas. The revenue per paying user is down from $27 to $25 per user. Bumble's had all kinds of problems of its own, and that's actually down over 90% since it listed. If you look at the two of them, I think there's concerns about both of them. And I'm not making a very attractive investment case. there is concerns about both of them. Both of them, the results are probably a bit more lackluster than you'd expect. But I think it's quite a similar approach as to kind of Fiverr and Upwork, where I just think in terms of the market, it's not going away. One thing that was interesting as well when I was reading about it was saying that it's very, very difficult for new competitors now, just because these apps are so established and people want to go where the people are. So you could create the best app, but if no one's using it, it's never going to take off. The last kind of new app that took off was actually Hinge. And what happened was Hinge did really well, but it was so difficult marketing to get the users that it actually went bust. And what happened was Match Group then just bought it. So very, very difficult in terms of it. I think it's essentially a duopoly and it's probably going to stay that way for some time. The market as a whole, although both of them have metrics that are going in the wrong direction, but overall you think over time it's a market that's going to get bigger. I don't see a scenario where people, you just see anecdotally as well, like it's less busy on nights out and stuff. And I think it is just by far the easiest way to meet people. In terms of valuations, both now looking extremely cheap, and Match is now trading at just over 8 times free cash flow. Bumble's only 6.5 times free cash flow. So I'm kind of thinking, actually, is there some sense to just taking a basket approach with the two of them? And it's more of a bet on online dating. What do you think, John? I know I've talked for a while.
No, I would agree with you that the basket approach would be a sensible one. And I would also agree with you in that I think online dating is only going to become bigger. So at the valuations, it's certainly very attractive. I definitely think that. And I mean, looking back over the last few years, I think these companies were eye-wateringly expensive, but that has changed significantly. Yes, it's, concerning, I think, in the shorter term that you do see the drop-off in some of the paying subscribers. But I think if you've got that overall thesis that online dating is only going to become bigger and they are going to obviously make the apps better too, and that breaking into it is incredibly difficult. So there's that sort of moat there in that people want to go where they're going to meet people. And even if an app is excellent, if nobody's on it, then people aren't going to want to use it. Then you are left with these two big players. So yeah, I can see your reasoning through that, and I would agree with it.
I'm just surprised at how poorly they're both doing. Because even Bumble, it's not doing great. You only need to look at the share price to know that. And it's gaining market share, but it's through dropping the prices. And that being said, both of them will just be churning out cash. So neither of them are going anywhere. But yeah, I just think it actually predicts, because the thing is as well, I'd only looked at Bumble because I was taking a view of whether to buy Match. But then when you look at Bumble, it's like, well, in the US, I would never have expected the Bumble market share to be just 1% below Tinder's. I kind of felt like Tinder was much further ahead. And I think a few years ago that was the case, but I did not appreciate how much Bumble had caught up. That being said, some of Tinder's loss has also gone to Hinge. And when you add that in, Match Group's still doing better. But I think that, again, just kind of reinforces for me, it's like I would want a basket approach, because some of the stuff when I've looked at it, it didn't look the way I expected it to look.
Yeah. No, fair enough.
So.
Yeah. Off the cuff these this week.
Yeah. Which do you like the most and which do you like the least?
I probably like ASML the most, and the least, I'd say Heineken.
So I think for me, Heineken probably would be the least. I think Match Group looks interesting, but I don't think I can say that I like that the most, just because, as we've discussed, I would only consider it, I think, now as part of a basket. But as an individual company, I think for me, it would probably be JD Sports, actually, just because I think that valuation is so low. And I know it's dangerous trying to catch a falling knife, but if I hadn't just gone out and bought Nike, I'd probably go and have a serious look at it.
Fair enough. Well, on that, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.